Hey everyone, welcome back. Today, we're going to be taking a deep dive into something that has the potential to be a real game changer in the world of investing.
Oh, yeah.
ETFs that offer 100% downside protection.
Seriously.
Yeah, you heard that right,
Yeah.
100%.
Wow.
We've got a stack of articles here, and
Oh.
trust me, this is going to get interesting.
Well, one thing that has really caught my eye recently is this incredible surge in popularity of buffer ETFs.
Hmm.
I mean, a few years ago, they were practically unheard of, and now we're talking about a market worth nearly $50 billion.
Yeah, that's a meteoric rise.
Right.
It makes you wonder what's driving this frenzy.
Right.
Why are investors suddenly flocking to these ETFs?
Well, I think you got to think about the current market climate.
Yeah.
Volatility is the name of the game. We've got rising interest rates, inflation worries, geopolitical tensions. It's just a recipe for uncertainty.
Yeah.
And in times like these, investors naturally crave ways to protect their hard-earned money.
All right, it's like everyone's looking for a safe haven, a way to kind of ride out the storm without getting completely soaked.
Exactly. And that's where these buffer ETFs come in. They offer something truly unique.
Okay.
The potential for growth without the fear of losing your initial investment.
So almost like an insurance policy
Yeah.
for your portfolio.
Okay, now you've really got my attention. But how do they actually work? What's the secret sauce behind this downside protection?
Options.
Okay.
That's the key ingredient. Buffer ETFs utilize options to create their defined outcomes. In simple terms, they buy and sell, put and call options on a specific index like the S&P 500 to essentially build a buffer against potential losses.
So instead of just holding the stocks directly, they're using options to create a layer of protection
Yes.
around those investments. That's pretty clever.
It is, but there's a trade-off, of course.
Oh, okay.
You're getting this amazing downside protection, but in exchange, you're accepting a limit on your potential gains.
Ah, so there's no such thing as a free lunch, even in the world of finance.
Right. You're basically trading some potential upside for the security of knowing your initial investment is safe.
Precisely.
Okay.
It's all about balancing risk and reward. And for some investors, particularly those nearing retirement or those who are simply more risk-averse, that trade-off might be very appealing.
I can definitely see the appeal. But let's talk about the pioneers in this space. Who are the key players behind these 100% downside protection ETFs?
Well, one name that stands out is Innovator Capital Management.
Okay.
They're the brains behind defined outcome ETFs, which include these buffer ETFs. In fact, they were the first to launch ETFs offering that coveted 100% downside protection.
So they were the trailblazers, the ones who really put the strategy on the map.
Absolutely. And they've been incredibly successful. Our research shows that Innovator, along with other companies like Calamos, First Trust, and Allianz, are now offering a variety of these ETFs with different outcome periods. You can choose from 6 months, 1 year, or even 2 years.
Wait, outcome periods. What are those and why do they matter?
That's a great question. The outcome period is basically the time frame during which the buffer and the cap on your returns are in effect. So if you choose a 1-year outcome period, you're essentially locking in that 100% downside protection and the predetermined cap on your gains for that entire year.
Okay.
To truly reap the benefits of the strategy, you need to hold the ETF for the entire duration of the outcome period.
Interesting. So it's not like a traditional stock where you can just buy and sell whenever you want. There's a strategic element here in terms of timing and choosing the right outcome period for your investment goals.
Exactly. And that's what makes this so fascinating. It's not just a passive investment. You need to understand the mechanics and think strategically about how these ETFs fit into your overall portfolio.
Okay, so we've got a basic understanding of what these 100% downside protection ETFs are and how they work. But let's get to the heart of the matter.
Okay.
Why are they so appealing? Especially for those of us who are passionate about finance and investing.
I mean, imagine this. You can invest in the stock market, participate in potential gains, but know that no matter what happens, your initial investment is safe. It's like having your cake and eating it too right.
It almost sounds too good to be true.
Well, it's important to remember that there are trade-offs involved.
Right.
You are giving up some potential upside in exchange for that peace of mind. But for certain investors, particularly those nearing retirement, that trade-off can be incredibly valuable.
Especially in today's volatile market. It's like having a safety net for your investments, knowing that your principal is protected even if things take a turn for the worse.
Precisely. And it's not just for retirees. These ETFs could also be attractive to risk-averse investors or anyone who believes we're heading into a bear market.
Okay, I'm starting to see the bigger picture here. But let's talk specifics. What are some of the key players in this space, and what kinds of products are they offering?
Well, we've already mentioned Innovator. They're a major force, and they offer a range of defined outcome ETFs with varying levels of downside protection and outcome periods. But they're not alone. Companies like Calamos, First Trust, Allianz, and even iShares are getting in on the action, each with their own unique twists on the strategy.
So it sounds like there's a lot of variety out there for investors to choose from.
Absolutely, and that's one of the things that makes the space so exciting.
Yeah.
There's a growing menu of options, each with its own set of features and benefits. You can choose the level of protection you want, the outcome period that aligns with your investment goals, and even the underlying index you want exposure to.
So a customized insurance policy for your portfolio.
Exactly, and that customization is key.
Yeah.
It allows investors to really fine-tune their approach and create a strategy that aligns perfectly with their individual needs and risk tolerance.
Okay, I'm definitely intrigued. But before we dive deeper into the specifics of these ETFs, I think it's important to take a step back and really understand the potential impact they could have on the investment landscape.
I agree. This is where things get really interesting. We're potentially witnessing a paradigm shift in how we think about risk management. 100% downside protection ETFs are challenging the old playbook.
Yeah.
Especially when it comes to the traditional 60-40 portfolio of stocks and bonds.
You're bringing up a really important point. A lot of folks are familiar with that 60-40 approach.
Right.
60% invested in stocks for growth, 40% in bonds for stability. But lately, that's been less effective.
Exactly. Low interest rates for so long made bonds less appealing for income, and now with rates rising, the value of existing bonds can take a hit.
Right.
That's why these new ETFs are so intriguing. They offer an alternative way to manage risk, particularly for that portion of the portfolio that's traditionally been allocated to bonds.
So are you saying these ETFs could potentially replace bonds in a portfolio? That would be a huge shakeup.
Not necessarily replace entirely, but they certainly present a compelling alternative for a portion of those bond holdings.
Okay.
Especially for investors who prioritize capital preservation over generating income from their bond allocation.
That makes sense. But let's talk about the potential downsides. Is there a catch here? I mean, if these ETFs are so great, why isn't everyone using them?
Well, the primary trade-off is the capped upside potential.
Okay.
If the market skyrockets, your gains are limited by that predetermined cap. You're essentially giving up some potential profit in exchange for that downside protection.
Oh, it's like buying insurance. You're paying a premium for that peace of mind, and if nothing bad happens, well, you haven't lost your premium, but you haven't made a huge profit either.
That's a great analogy.
Yeah.
It really comes down to individual risk tolerance and investment goals.
Right.
For some investors, the certainty of knowing their principal is safe, especially in a turbulent market, is worth more than chasing potentially higher returns.
Right. It's all about finding the right balance for your individual circumstances. But I'm curious, what about the argument that taking on some risk is essential for growth? Aren't these ETFs encouraging investors to be too conservative?
That's a valid concern, and it's a debate that's been going on for ages in the investment world. But remember, these ETFs are just one tool in a toolbox.
Right.
They can be used strategically as part of a diversified portfolio alongside other investments that might carry more risk, but also offer higher potential for growth.
I see your point. It's not an all-or-nothing proposition.
Yeah.
You can use these ETFs to create a foundation of stability, a sort of safety net for your portfolio, and then layer in other investments based on your risk tolerance and goals.
Exactly. And that's why financial advisors are getting so excited about these ETFs.
Okay.
They can use them to create more customized and robust portfolios for their clients, especially in today's volatile market where traditional approaches are being challenged.
I imagine these ETFs could be especially helpful for advisors working with clients who are nearing retirement or already retired.
Right.
Those are the folks who are most concerned about protecting their nest egg, right?
Absolutely. For retirees, preserving capital is often the top priority. They need to make sure their savings will last throughout their retirement years, and they can't afford to take on too much risk.
Right. It's not just about maximizing returns at that point. It's about creating a sustainable income stream and making sure you don't outlive your money.
Exactly. And that's where these ETFs can really shine.
Okay.
They offer a way to stay invested in the market, participate in potential gains, but do so with a level of protection that can bring real peace of mind.
And as you mentioned earlier, the variety of these ETFs on the market is growing rapidly. Investors can choose from different outcome periods, different levels of downside protection, and even different underlying indexes.
Right.
It's like having a custom-tailored suit for your portfolio.
Precisely. And that customization is key. It allows investors to really fine-tune their approach. Yeah.
And create a strategy that aligns perfectly with their individual needs and risk tolerance.
Okay, I'm starting to get really excited about the possibilities here. But before we wrap up, I want to make sure we're providing our listeners with some actionable takeaways.
Sure.
What are some key things they should keep in mind if they're considering adding these 100% downside protection ETFs to their portfolio?
That's a great question. First and foremost, it's important to do your homework. Don't just jump into these ETFs because they sound cool.
Right.
Take the time to understand how they work, the trade-offs involved, and how they might fit into your overall investment strategy.
Right. Knowledge is power, especially in the world of finance.
Absolutely. Secondly, remember that these ETFs are not a magic bullet. They're a tool.
Okay.
And like any tool, they need to be used appropriately and strategically.
So it's not just a matter of throwing money at these ETFs and hoping for the best. Exactly. You need to think carefully about your investment goals, your time horizon, and your risk tolerance. And if you're not sure where to start, it's always a good idea to consult with a qualified financial advisor who can help you make informed decisions.
Solid advice. So as we wrap up this deep dive, what are some final thoughts you want to leave our listeners with? What's the big takeaway here?
Well, I think the main takeaway here is that the investment landscape is constantly changing and evolving.
Yeah, it's true. And in this environment, investors need to be open to new ideas and strategies. You can't just rely on the old ways of doing things.
Exactly. And these 100% downside protection ETFs represent a truly innovative approach to risk management.
Yeah.
Especially considering, the limitations we're seeing with these traditional strategies like the 60-40 portfolio.
It seems to me that these ETFs could be a real game changer for investors who are looking for ways to stay invested in the market, but without exposing themselves to significant downside risk.
I completely agree. And I think we're just scratching the surface of what's possible. As more investors become aware of these ETFs, and as more companies kind of enter the market, we're likely to see even greater innovation and product development.
Yeah, it's exciting to think about the possibilities.
Right.
Imagine ETFs that offer downside protection, but with uncapped upside potential.
Oh, yeah.
Or ETFs that dynamically adjust their buffer levels based on market conditions. Who knows what the future holds?
The possibilities are truly endless.
Yeah.
And that's what makes this such an exciting area to watch.
So for our listeners out there, the key message is stay curious, stay informed, and don't be afraid to explore new investment strategies that might help you achieve your financial goals.
Absolutely. Knowledge is power, especially in the world of finance. And who knows, you might just discover the next big thing that revolutionizes the way we invest.
That's a great note to end on. So to all of you tuning in, thanks for joining us on this deep dive into the world of 100% downside protection ETFs. We hope you found it insightful and thought-provoking. Keep exploring, keep learning, and as always, invest wisely.